Welcome to Sorcery's first podcast. I'm your host, Molly O'Shea, the founder of Sorcery, a weekly top VC deals and tech newsletter. Published every Tuesday morning for the past 4 years, we're going to try out a new format. The purpose of our podcast is to highlight the top GPs, founders, and deal announcements leading the emerging trends of the next innovation cycle. Today we have Xander Oltmann, founder and GP of Commodity Capital, an early-stage venture fund focused on vertically integrated monopolies with investments in Hadrien, Varda, Hadrian and Armada. We're going to talk about the downfall of SaaS, rise of vertically integrated monopolies, what those mean, the dislocation and growth stage investing markets, and his predictions for 2024. Okay, hi Xander. Let's start from the beginning. Where did you grow up and what led you to start Commodity Capital?
Yeah, so I actually grew up in LA, spent my spare time surfing, and actually lived in San Francisco for about 13 years and then just moved back here not that long ago. I started my first company right out of college, which is a company called HiQ Labs, and then started my next business about 5.5, 6 years after that, which is a company called Scope. And that's really kind of given me the full spectrum of what it's like to build an enterprise software company. From a few founding folks to a fairly large business. And about 4 years ago, I actually got my start investing. David Sachs was kind enough to give me a small fund to start investing out of, which is where I started to develop my thesis around the dropping cost of software and how that's leading towards a shift away from pure play SaaS and leading more towards vertically integrated companies. So I decided to actually spin up an entire fund called Commodity Capital around investing in companies at the pre-seed and seed stages, and looking at how vertical integration can help historically non-scalable businesses become hyper-scalable. So the main focus for Commodity Capital is to partner with exceptional founders who are taking advantage of the declining cost of software to build these vertically integrated monopolies, especially around like the hard tech areas. So Commodity Capital so far has been backed by David Sachs and a handful of family offices, as well as a few other publicly traded, CEOs and folks like that are all super helpful.
And in terms of vertically integrated monopolies, would love to get into that a bit deeper. For those who might not have context on it, could you share more about what vertically integrated monopolies mean and more about the effects of declining software development costs and the opportunities being created because of that?
Yeah, absolutely. So where I'm kind of talking about, the complex vertically integrated monopolies, there's really like two layers of this. So the first layer are the companies that are actually, leveraging the declining cost of software. So, across the top, we've got startups like Hadrien, Varda, Swarm, Albedo, Armada. And what they're really using are three main pillars that I've seen, become either hyper cost effective or things that are just super easy to build. So modern software stacks, like it's so cheap and easy to build enterprise software applications. So, pushing that further and making it easier for companies to vertically integrate, just like internal systems. The second piece of that are APIs. So APIs are extremely abundant now. We see them everywhere with companies like Stripe and Plaid and Twilio. These are kind of like those foundational building blocks that historically you've had to build internally, but now, there's massive API companies that have been created. And then finally, artificial intelligence, which is, we'll dive into this a little bit later, but where I see this really playing in is taking what a company might do, like a Hadrien, for example, in their customer workflow system, make it really easy for customers to just like build better and design better aluminum parts. So that's, some of the pillars. And then, when we start to think about outside of just like startups, I wouldn't say OpenAI is really a startup anymore, but we're starting to see vertical integration, not just of hardware first companies, but also for software first companies. So those of you that don't know, OpenAI is currently out in the market now trying to actually build their own chip factories and develop their own chips internally, which is a total shift away from historically what software companies have done. Maybe even like in the horseshoe theory here, way back in the day when software companies had to spin up their own servers and have their own racks, we're kind of like almost going back to that, but in almost like the backwards way, which is pretty funny. And then finally here, the big main theme here is just the collapsing cost of software development. So this really spans four main categories and why we're seeing this happen. So software engineering salaries are fairly flat year over year. This chart is a little aggressive on forecasting the declining cost of software engineering salaries. But I think with a lot of the co-pilots that are coming out, it just makes, one engineer as good as 10 engineers. It makes their job a lot easier to do and makes them much more higher leverage. And then the second part here is storage. So storage is cheap and getting cheaper. Bandwidth, we've got, satellite-based ISPs like Starlink that are coming online now. So bandwidth is getting cheaper and much more abundant. And then finally, CPUs are super, super cheap today. We might see GPU spike in demand, cause that to increase in price for the time being, but I think that's just a moment in time for right now.
So I've definitely started to see this narrative catch on, which must feel very validating for you. Although at this point you have won 2 bets against me, so you're on a roll. Have you started to see others catch on to this? What's going on in the broader techverse, Twitter sphere, all the good stuff?
Yeah, so a good close friend of both of ours, Delian, recently on a podcast, had mentioned that SaaS funding is down to a 5-year low, and then a layer deeper than that, he's also saying that VCs are finally waking up to the fact that zero marginal cost in the short term means zero margin in the long term, and then transitioning over to something a little bit more along the lines of the dropping cost of software, and we're seeing that happen. Is that Christian Keel, pronounced Kyle, is saying that the SaaS era is over. And his reasoning is that it's really ridiculously easy to build and to copy companies, or really easy to copy and build applications that are already built. So what that really means is that your only moat as a business at that point is just distribution. And distribution really at the end of the day is sales and marketing. And so you're starting to see sales and marketing budgets for SaaS companies like go up pretty significantly. So there's not really a moat around the technology anymore. It's really around like the marketing and the distribution. And then, a big narrative shift that we've also seen with just like the more broad kind of general market, especially with David Friedberg and the All In Pod, is that he has short vertical SaaS and long tools that allow companies to build their own product. So we're starting to see this shift, anecdotally, but then also in publicly traded companies, like I mentioned, Snowflake, where they're spending more in sales and marketing, they're actually spending in research and development.
For one, I'm a big fan of all 3 of those people. I'm not saying that David Friedberg is my favorite on All In, but he might be. I guess in terms of those are all kind of centered towards startups. So what about public equities? Anything on that side?
Yeah, so I mean, Snowflake is like a fantastic example of this. So we've anecdotally looked at these 3 comments, but if you look at a company like a Snowflake, they're spending a ton of money on sales and marketing, more so than they actually are spending in research and development. So I think what that kind of shows you is that that's really like the final moat. And on average, a company assuming no net new customers, assuming no expansion, they basically churn through 30% of their customer base a year. So in the span of 2 to 3 years, I think what we're really going to start to see is this narrative really catch up with publicly traded companies that already have these like massive user bases. So I think it'll be interesting to see what happens over the next 2 to 3 years with publicly traded SaaS companies.
There was an amazing comparison that someone had in one of their previous LP letters, that was comparing the financial profile of, I think it was Tesla versus Snowflake. We can get into that later, but in terms of this overall narrative, is SaaS dying? Do you think AI is going to save software companies? What happens to all of those out there? Do they adapt this new component into their product suite or rebuild? Or maybe this has happened before and we're being like a little bit dramatic.
Yeah, so I've actually seen this story play out once before. And so where I actually have like a fairly good insight here is that my first company I started was a predictive analytics company. And so what I'm actually seeing with this current flavor of AI is almost identical to what happened almost 10 years ago now, a little more than 10 years ago, with predictive analytics. And so this was the big rage back then. Might have been before your time, Ollie, but there was a huge run of acquisitions that Salesforce and Workday were going on. And so, Prediction IO was a machine learning as a service business that was open source. They were then bought by Salesforce and tucked in there. And then Salesforce went out and bought a sales and marketing related predictive analytics business called Relate IQ, which is now their Salesforce IQ product. And then Workday, obviously, sitting on all of that HR data that they have, was able to, acquire a handful of predictive analytics companies. And funny enough, today, actually, in how the comparison between predictive analytics 10 years ago with the current flavor of AI that we're seeing, Ramp just acquired a procurement business that was focused just on AI as like their moat to their business. And so where I think, this might play out, where we're seeing it happen already, is that the unique technologies might get acquired. I doubt that most of these companies will go public. You could say that for any early stage startup, but I think the AI as the moat businesses are going to have a really hard time. And where I'm already starting to see winners, which we all are one at the model layer. So think OpenAI, think all the companies that were funded 3-4 years ago, and then you look at the companies like NVIDIA that are making tons and tons of money, as well as the data center businesses like GCP, Azure, AWS. And then where I see, again, more of the same flavor of predictive analytics to AI, a lot of those companies, a lot of the large incumbents were also building their own products internally around predictive analytics. And so now we're starting to see that happen with AI products as well. So within the first week of ChatGPT being announced, Bloomberg actually already, had the API, had already integrated it, and you could ask their GPT any questions about anything that was in the financial business that was going on. So I think it's just much easier and quicker now than ever, even before the predictive analytics era, to now just like integrate all of these things, in a very short amount of time.
Okay, so in a previous LP letter of yours, you compared Snowflake to Tesla. In the world of vertically integrated monopolies, what would you compare there?
Yeah, so I actually would draw the comparison, which I think is a better apples to apples, for just like how important this like vertical integration theme is if you compare Tesla to Ford. So what we see here is, Ford is almost like double the revenue of Tesla, but if you look down at their expenses and you look even further down in their net income margin, that just absolutely highlights like how critical and how much leverage if you actually build all your own tools internally, software or hardware based. And so, we can look back at a prior Tesla shareholder meeting that they had, and they actually showed you all of the products that they've built internally as what they call their Tesla operating system. So it's everything from customer experience to employee experience, service and support, fulfillment and charging. So you've got all these different categories that Tesla's actually taking on internally. And so, if you look at that apples to apples comparison, we can just see, how actually important this actually is and where this actually starts to show up, and how the business is run and how it does financially. So I think it's more critical than it's ever been to actually, use vertical integration, use that drop in cost in software, to really drive your business and build these, historically what would be considered a institutional like incumbent business like a Ford, and how a newcomer can come in, totally rebuild and rethink a factory, rethink how you build a business, and use that vertical integration operating model as a way to just absolutely blow the doors off of your next best competitor. So again, if you look at the net income here, Tesla makes half the revenue, but they also make more net income, which I think is just an absolutely wild stat. It just goes to show how important vertical integration is and how much it can actually improve your business.
So I guess a wider question from that, why are you focusing on hardware-driven companies versus software-driven companies that can vertically integrate their entire stack and maybe like automate their engineering functions with more co-pilots, their marketing stack with more co-pilots? really get to operational efficiency. Why are you focusing on these hardware-driven companies versus broader software?
Yeah, so I don't necessarily just invest in, pure hardware businesses. I like to invest in really anything that's like pushing that narrative of vertical integration. So I've definitely got a bunch of, hardware businesses in there like Hadrien and Albedo and Varda, as well as Senra. But I also have a company that's yet to be announced that they're building a copilot for firmware development. So firmware, for those that don't know, is the stuff that helps your software talk to your hardware. And they're actually building an entirely net new firmware development platform that hasn't really been created for at least a decade and a half. And so there's just a lot of low hanging fruit that I think you could build a net new platform that allows you to really push that vertical integration thesis even further. But to answer the original question, there's a lot of just like historically non-scalable businesses that if you just vertically integrate them with a bunch of software, you can actually make them fairly, very, very scalable. Chris Power from Hadrien, not that long ago on Twitter said that, Hadrien's got like 70% gross margins and they're growing in the top 3% of all SaaS companies, which is just absolutely astounding. Number one, like ability to pull that off, especially in manufacturing. But two, really proving everybody wrong that said, these are non-scalable businesses, and you can define venture scale as however you want. But in my mind, scaling faster than top 3% of all SaaS companies and 70% gross margins is to me a venture scale business.
For those that don't know, what is Hadrian? Could you share more on that company? Because you were a very early investor.
Yeah, so Hadrien is building an automated factory to make precision aluminum parts. So that's everything from aerospace, defense, anybody that really needs aluminum parts, you can go to Hadrien and you can have the world's best customer experience with all the cool software that they've built internally. And again, vertical integration there is the name of the game. And Chris is also just like one of the most astounding founders I've met. So that's Hadrien in a nutshell for you.
Great. Yeah. Well, hard tech has seriously taken LA by the reins. Everyone seems to be loving it. However, there is a narrative violation here. In the previous, like most recent LP letter of yours, you did mention the shutdown of a popular emerging manager. What's going on there? Is this going to continue? Is this an emerging trend? Should we be concerned?
Yeah, so you're talking about Countdown Capital, and Jay Malik, who's a good friend of mine. And so he really outlines two main reasons for winding down the fund. The first one was that pricing for aerospace and defense companies and industrials was getting too expensive. And then the second part was that it was just getting harder and harder to compete with multi-stage funds that were now coming into the space. So I definitely agree with Jay on the pricing discussion. We've seen a lot of supply of capital for very little, high quality demand in businesses and companies that are getting spun up. And so there are a decent amount of companies that are getting funded today that I would say would fall more on the science project side, less on the actual, near-term commercial viability side. And so that really kind of puts into question, who's investing and how are they kind of taking what we had as a little cottage industry for the last, 3 or 4 years, and now it's becoming a really main theme for a lot of different funds, and a lot of different just like investors coming into the space. And then kind of dovetailing on more investors coming into the space. When it comes to big multi-stage firms, I disagree with Jay on how difficult it is to invest with them or against them. And so I love to partner with big multi-stage funds like Founders Fund, General Catalyst, Sequoia, just to name a couple. And so where I see a lot of the benefit is one, having like a big brand name in there. For the earlier stages, makes it a lot easier to hire. It just gives you a lot more credibility as a startup. And then, in the later stages of running a business, when you get to the B, the C, the D, pre-IPO, these multi-stage funds have very, very large, LP bases that they can draw their capital from. And so I think, it's going to be very, very critical going forward to have big multi-stage funds a part of the game, because these are capital intensive businesses. But I don't necessarily see that as a bad thing. And so, having that big multi-stage fund, being able to write that big pro rata check, or like that super pro rata check where they're going to double down, is going to be really critical to make sure that these companies, make it all the way through to IPO and beyond. And so, to basically kind of summarize here, I think it's one, pricing appreciation for industrials, aerospace, and defense has definitely happened. But again, partnering with a multi-stage fund is just going to make that business stronger, and it's going to make you as an investor on the cap table, a better business in general. So I'm excited about that piece, though.
All right, to switch to something more fun, do you have any portfolio companies outside of Hadrien that you want to highlight, or is there anything interesting getting funded right now?
Yeah, so a company I'm super excited about is a company called Armada, and so they just announced their Series A not that long ago. And what they've done is they've actually built the world's first full stack computing platform. So they're taking advantage of the shift to satellite-based ISPs like Starlink, and also fully vertically integrating the whole thing. And so what that allows you to basically do is have remote data centers. So if you're in the middle of nowhere, if you're working on an oil field, you can actually run best in class AI models. You can munge a bunch of data really anywhere in the world. And so the team there, which is Dan Wright and John Runyon, who I've known for a decent amount of time now, are both like the best absolute founding team. They're actually very good friends too, which is just makes it a lot easier. But they've been able from day one to prove that they just have absolutely the most unfair advantages across the board with just their operating experience as well as their relationships, and their ability to build a fantastic team too. So I'm very excited about Armada.
Close us out strong, Xander. What are your 2024 predictions?
So my big prediction for this year, I've bet my life on it, is that vertical integration takes center stage as the next great operating model. Number two is that startups are going to start going public again this year. We actually just saw this last week that Reddit is just announced that they're going to file for IPO somewhere around the $5 billion mark. They are, 50% below their last private market valuation, but I think that's just going to be the narrative of IPOs going forward, from their high water mark that they saw in the private markets. And then the second half of this year, I think we're going to see a significant increase in just dollars deployed from venture funds. That's also going to be on, individual check sizes, I think, are going to go up again in the later stages. And then also just like number of deals getting done is going to go up significantly as well. So those are my big three predictions for 2024.
Okay, so very techno-optimist of you, Xander. So bullish on vertical integration, bullish on more dollars deployed, maybe even some IPOs. This is all very good, positive sentiment. So fingers crossed. And thank you so much for coming on the podcast. If you haven't checked out Commodity Capital yet, it's commoditycapital.xyz. They are not a crypto company, so don't bring it up. And I shouldn't have even said that, but thank you so much, Xander.
Yep. Thank you, Molly. And looking forward to the first of many, many, many podcasts that you've got coming out.
Maybe we'll have you back. And if you haven't already subscribed to Sorcery, it's a top VC deals tech newsletter. So we're published every Tuesday. It's just the top deals of the week in one shot. It's sorcerydeals.com. Thank you.